All right, just a few minutes left until the closing bell on this Monday. Joining us right now from the Chicago Board Options Exchange, Doug Prskalo of Blue Capital Group. Doug trades S&P index options. Also with us, Nick Sargen, Chief Investment Officer over at Fort Washington Investment Advisors, where he helps manage more than $30 billion. Nick also worked at the Federal Reserve Bank in San Francisco and at the Treasury Department. And Nick, I want to start with you because you expect this choppy, mostly sideways trading action to continue, correct?
That's correct, Carol. You know, basically, I think the drag, obviously, is that we've lost some momentum on the economy, and I'm hoping it's just a soft patch, but I don't see the impetus for a quick turnaround, so that keeps the market, I think, on guard. And then the good news is that despite that, companies continue to perform remarkably well. I was looking at the level of profits out of the second quarter. This is off of the GDP data, and we're basically back to the peak. So you've had a V-shaped profit rebound for a shallow economic recovery, and I think that keeps you in a trading range.
You know, from your experience at the Fed, I'm sure you know that the dual mandate is keeping inflation low and keeping unemployment low. Is there anything the Fed, though, can do for the jobs picture? Do they have any kind of bullets that will get a bang for their buck at risking mixing my metaphors?
Yeah, I think, Matt, it's going to be tough. The way I look at it is the Fed, you know, we had round one quantitative easing was the right thing to do when you thought that the financial system was on the brink of collapse. And then they basically just printed money galore. And what that did was that arrested the decline in the financial system. But I think to say now let's do quantitative easing round two, can that then create new jobs? I think that's different. So I would look for them to do that if they got worried about deflation or falling prices. But I don't view that. The ball is in the administration's court on how to create jobs.
Right. Hey, Doug, just got a few seconds before the bell. You surprised that we're seeing that upward momentum in stocks today, considering the jobs report we got on Friday?
Yeah, I think so, but I think that's, everyone's hoping for some surprise from the Fed tomorrow, some sort of help for the market here. I'm not guaranteeing it's coming, but I think that's the mindset down here. Nobody wants to get caught short if the Fed decides to do something.
Doug, I want to bring you back into the conversation because you're down there on the floor. We are now focused on the Fed meeting tomorrow. What could the Fed possibly say where we'll get some kind of significant reaction from the financial markets?
I think that if the Fed creates some sort of stimulus, maybe some Treasury buying again, I think we'll have an upward move. I think if they sit back and just say they see a slow recovery, or if even if the verbiage after the announcement, if the verbiage afterwards is a kind of a, blasé kind of, well, we're just hoping the market recovers, I think that could have a significant impact down here. If you see the S&P's trading above the 1100 mark for probably the 30th time, I'm exaggerating, but it sits and it's teetering there and it's waiting for good news. My fear, and I'm not a bear, but my fear is that we're just running out of reasons to keep this market up here right now.
Hey, Doug, it's Dominic here. Just really quickly, we talked earlier today about some of the things that the Fed can do, and Adam Johnson and I took a look at the futures picture, and the Fed funds futures are implying pretty much only a 1 in 4 shot that even next year they're going to raise interest rates. Is that what you guys are seeing down there? Is there any fear of the Fed actually raising rates anytime soon?
I don't think there's fear. I mean, I think they know what the outcome would be if they did. If they, shock the market here and raise rates, I think they know what the outcome would be. So I think they'll stand pat. I think the problem that's happening right now is we keep going, they're not raising. It sends kind of an inverse message to the market that things really aren't getting that much better. We see a few rays of hope down here and a few things getting better, but there's still a job problem. We still have a high jobless rate, and it's still hard to get credit right now. And I think that's the Fed. I mean, that's the government's decision to get involved and maybe stimulate this, because right now, just, not raising rates, it's not good enough anymore. I think that's kind of what the market's feeling right now.
Nick, what do you say to that? Because, you have the government making it even harder now to get a loan, or at least more expensive to get a loan to buy a house. And it doesn't look like they've made a lot of progress on the jobs front, although Christina Romer would have obviously disagreed with me on that.
Yeah. I think, though, I agree with the speaker that, I think the market has its hopes up that the Fed's going to do something, and my call, Matt, would be there is the risk of disappointment. I think that, in the past, they were talking about exit strategies. Now they're talking about, contingency strategies if the economy should weaken again. But I don't think they're at that point yet where they got to pull a trigger that would be at all meaningful. To me, if I was in their shoes, I want a little bit more concrete evidence. Because this economy, it's not falling off a cliff. It's just disappointingly slow on jobs. The one bit of encouraging news I have seen of late, and this came out of UBS's economics area, for the first time, we're starting to see some hiring in the smaller company area. Say that's the last 5 months. It's been modest. But the other thing that has gone hand in hand is there's been some loosening of credit conditions on the part of the banks. So this is the sort of thing, again, I think that the Fed will want to encourage, is that banks make loans available to businesses that are in good shape.
I'm not trying to jump in here, but I think the problem is, I'm not disagreeing whatsoever, but the problem is we've been hearing that now for a year, that the banks need to ease their credit line and let people walk in and get a loan. But I mean, me personally, where I live, I don't see it, and I don't get a sense from any people I'm around that it's getting any easier. So my question is, how long does that go on? How long before the government steps in? I mean, they had a home buying tax credit that worked, but that's over with right now. Do they reinitiate that? And how many times can they reinitiate that?
Well, that's right. And again, I'm trying to make the argument, not that I don't think it is dramatically visible. In fact, as I say, I wasn't even aware so much of some of these things. But you've got the guys that are crunching the numbers that are at least pointing out that there's just, I'd call it glimmers of hope.
Right.
Now, again, I think on the jobs front, though, that's not, the Fed's job isn't to create jobs. That's really the job of the U.S. government and Congress. And, and there we're into the old debate of, do you do round 2 of fiscal stimulus when there's a lot of criticism of how round 1 went?
Right.
I think, personally, of all the ideas I've heard, that the idea of cutting payroll taxes on especially a certain category of workers makes some sense. Because I think that the hard thing for businesses is they're saying, if I bring on a new worker right now, that's very, very expensive for me in terms of taxes and in terms of new health care costs I'm going to be incurring. And I think the administration at some point has to say, wait a minute, we've got to do, this is the area that has money to hire, is business, and they're not doing it. Government doesn't have the money. In fact, they're now laying off workers themselves at the state and local level.
Nick, it's Julie here. I do want to bring it back to the Fed for just a second here.
Yes.
And just say, if the Fed does come out and announce something over the next few days, even though a lot of people don't think they will,
yeah.
I mean, as you say, is this going to make any difference? And more importantly, will the market read it as such? I mean, even if the Fed does announce something, will the perception be that
Yes.
that's going to move the needle?
It might have a favorable market response in the short run, but I honestly don't think, what do we have on the table is that they have mortgage-backed securities that are now rolling off of their balance sheet. And so the idea is, well, let's at least not let the balance sheet shrink, so let's go out and buy some new treasuries to offset that. Well, again, I think the market may interpret that favorably in the short run, but I can assure you the magnitude of what they're talking about is not going to make a dent in the unemployment rate.
Right.
And it's, if you had really a major round of quantitative easing, I'm saying I save that for if I get a worse scenario that, we're going back into the soup. That's when, if I was, my joke is, if I was Ben Bernanke, I'd say that the Fed is announcing purchases of a fleet of helicopters and he can get back to helicopter Ben, but that's not going to happen.
All right, Doug, we've saved 30 seconds for you. One thing I want to go back to the markets. We've had the slowest in terms of volume, NYSE volume, the slowest since New Year's Eve. So, yep, we got some gains today, but there's not a lot of conviction behind it, is there?
Yeah, as we say down here, it's just basically on air right now. Nobody wants to get cut short. I mean, caught short tomorrow going into the number. But, I mean, you've seen this market. We've been above 1,100, like I said, jokingly, 20 or 30 times. We could easily be back down to 1080 in a day or even tomorrow if they don't hear what they want to hear.
All right, we'll certainly find out in about 24 hours from now. Hey, Doug, And Nick, thank you so much.